Welcome, ladies and gentlemen, to Flow Beverages channel, an alkaline spring water in a sustainable package with 54,000 points of distribution across North America. Joining us to give us a high-level overview of the company, a bit of his history and some milestone expectations, we have Nicholas, the founder, chairman, and CEO. Welcome, sir.
Wow, thank you for having me.
Yeah, and a pleasure to get you on. So this should be a fascinating conversation because for newer audiences, you're kind of offering this incredible product with 100% renewable energy facilities, plus up to 75% renewable plant-based packaging that is 100% recyclable. So do you want to give us a brief elevator pitch? What exactly is Flow Beverages doing?
Excellent. Well, this is Flow right here. This is one of our flavored, organic, certified flavored water. This one won Best Flavored Water on the planet 2 years in a row. But Flow is birthed from my family's artesian mineral water spring in Canada, here in Ontario. It releases about 4 million liters a day of the highest quality still mineral water sold domestically here in North America against competitors like Fiji or Avion in plastic bottles. What's interesting about Flow, outside of the quality of our mineral water, makes us the highest quality mineral water with functional benefits like alkalinity and electrolytes. It has a very smooth taste, but I decided to do something totally different. I wanted to put it into a 100% plant-based, renewable resource, fully recyclable package. So we chose Tetra Pak, which is primarily made out of trees, all from responsible forestry, and even the cap is made out of sugarcane, making it the highest renewable resource plant-based package on the planet. I think this one has about 75% plant-based packaging, and our goal is to get it to 100% by 2030. And we launched it in 2015 on Earth Day, and it's been on a rocket ship ever since. We're listed, as you mentioned, at 56,000 locations across both Canada and the United States. It's available across all major grocery chains and drug chains, and Costco and mass market chains across Canada, and gas and convenience. And in the US, we're listed across all natural grocery and grocery chains as our primary route to market in the US. And things are going great. We have a very strong consumer base. 20 plus million consumers drink Flow on a regular basis, and it's growing rapidly. Our last quarter is Q3, and we're public on the TSX under FLOW as our ticker. And our last quarter, we reported year-to-date growth of 46%. So things are moving very good for Flow, and with a very strong consumer base into wellness and health.
I definitely appreciate these insights. When we come back, I want to expand on this a little bit farther, but I wouldn't mind kind of getting an idea of your expectations here for the latter half of the year. What are you guys most focused on? What should investors be paying attention to?
Yeah, so we announced on our Q2 in June that we were divesting either partially or fully from one of our facilities in Aurora, Ontario. And we'd built an asset-heavy model, our own logistics, our own manufacturing with Tetra Pak lines. We had 2 plants and 2 springs, one here in Canada in Aurora with my family spring, and then we bought a spring in Virginia and built a very large facility there to manufacture all of our US products. And then after that, we went public in 2021, and we realized that in order for us to really grow, we needed to get our equity out of that, out of the facilities and into building the Flow brand and continuing to build that 46 year-to-date growth as we move forward, and get the numbers much higher and our margin much higher. So what most beverage companies operate on is what's called an asset-light model, where they use co-packers. Instead of owning their own manufacturing facilities, they just partner with co-packers and pay a tolling fee. Because we had to build our infrastructure to produce water, because no co-packers actually produced water at the time, we built our 2 facilities, and we invested a sizable amount of capital into both of those facilities. In Virginia, we were just solely manufacturing Flow, and we opened it up to doing co-packing businesses with other popular brands. And so when we decided to move to an asset light model last year, we divested and sold our Virginia facility, and we capitalized the business. I think that in the tune of 19.6 million in cash, another $7 million worth of debt reduction. But we also saved about 13 million in operating losses that we were having from that facility by trying to ramp up our production. And we sold it to one of our partners, Canopy Growth, and they bought the facility to manufacture biosteel out of it. And so we sold that, and then we restructured the company in January by taking on some more debt to secure it against our Aurora facility, and then restructured the company to move it to profitability. And our last strategy that we announced is that we're divesting Aurora, which happens to be a very active co-packing plant, and it's also very profitable with a high EBITDA yielding margin. And so we're expecting multiples on our investment in that facility, and we announced it for sale. And we gave an update to the market in Q3 that the sale will be, commencing. It is commencing through a structured process, and we expect that to be done by the end of this calendar year, which will really further the last pillar of our growth strategy, which is continue the Flow brand growth on an asset light model, but also capitalize the business with free cash flow and cash to invest back into Flow. So that's what people should be expecting for the latter half of this calendar year.
On that note, I'll pass that question off to the viewers. We'd love to know what you think in that comment section below, and consider subscribing, because as news hits the wire and as the story evolves, we're going to continue to bring it to you here. But on that, we look forward to catching you in the next one.